Good afternoon, and thank you everyone for reading through those disclosures, and welcome to another one of Avant-Garde's free educational trading webinars. We are thrilled to host Keith Harwood this afternoon. He is joining us to speak with you all about identifying the next bullish stocks early. Keith, are you with us?
I am. Thank you again for hosting me today, Natalie.
Oh, my pleasure. Thanks so much for being here and for taking the time to put this presentation together. Thank you to everyone who is joining us live in the Zoom room. He's going to go ahead and pull up his presentation and get ready to get going here. Just a reminder to you all who are with us live, if you have questions during the presentation, please type them in the chat box, and I can get those to Keith at the end of his presentation for him to address live, time permitting. All right, awesome. Keith, I see your presentation looks great, so feel free to begin when you're ready.
So thank you again for everybody joining us, as well as AGT for hosting me today. So, today's topic is going to be identifying the next bullish stocks early. And, timing seems to be right here with some of these market moves that we've been seeing the last few days as we start to get into a potential new bullish trend. But before we get into that, I actually have my own disclosures as well. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. The information provided is for educational and information purposes only and should not be considered trading advice. If you can take a moment here to read through the rest of these disclosures, please do so, and then we will get into the content for today. With that, just an introduction, to myself for those that are not familiar with me. My name is Keith Harwood. I am a former market maker on the CBOE. Started my career back in 2005 as a market maker on the options floor there. Times have changed significantly in the last 20 years, but I shifted from market making in equity options to off-floor trading, directional trading, using options and futures as a market maker, proprietary trader, and a hedge fund trader. Now, working for the hedge fund that I was working with, it was a CTA, which is a commodity trading advisor. Historically, CTAs have a very technical focus on their approach to the markets. And so when I joined their team, we worked through how to utilize their technical trading knowledge and leverage the options market to create really nice setups for expected value by combining the price targets and the setups that they were finding with the options structure that I had built my career upon. And since working for them, I started into the educational space to help others trade smarter and really construct these similar trade ideas that we use in the professional institutional trading. So I joined Option Hotline in 2018 as the chief options strategist. Again, to share that expertise in options, equities, fixed income, and commodity trading with, again, an options focus and a technical focus. If you do have to leave early, here's my contact information. You can always email me, keith@optionhotline.com. I've also provided my phone number here. So if you want to reach out for a phone call, you can either email me to schedule a call or just call me directly, 312-600-8004. During market hours, I'm usually free to take a call. If I do miss you, hit me up with an email. And if you have questions that pop into your mind after the webinar is over, that's a great opportunity to reach out via email and we can discuss a little further. I'm always happy to discuss anything that we've discussed here or anything else that may be an extension of some of the concepts that we're going to cover. Also, make sure you keep an eye out for support@optionhotline.com for free giveaways. Those will be following up with you, I believe, tomorrow. And they're free, so no risk to you, no obligation to you, just stuff to help extend some of the knowledge that we're going to be discussing today. All right, and speaking of today, what are we going to be talking about? Well, it's really current market conditions. What is driving the current market behavior? Now, with all of that, I like to go into why I use options at all. And frankly, how can I use those options to leverage the kind of moves that are happening now? Because every different market environment has an option structure that works for it. When we have a market bull case, that may set up better for one option structure versus a bear case versus a market neutral case. And what we've had recently in the last few months, we've had the bear case. We saw what happened through March and early April. We've had the mega bull case coming out of the lows made early April. We've had the neutral case up until about Friday, where the market just chopped in a range. And now it seems like we may be setting up for that next bull scenario, at least in a number of different sectors. So how am I identifying those new trends before it begins? We'll discuss that. And of course, the sectors that look interesting today as those bull scenarios may be coming to fruition. So it's a lot to cover, so we'll get right into it. And I think, as Natalie mentioned, if you do have questions during the presentation, please feel free to throw those into the chat box and I'll address them live as I can or at the end. And again, if something else comes up, you can always feel free to email me afterwards. All right, so what's driving the market today? Of course, we've got tariff negotiations. The main one right now on everybody's mind, everybody's focus is China versus the United States, right? These negotiations have stalled, picked up, stalled, picked up. They've gone south. They've gone back to a little bit more neutral. At the end of the day, we don't have anything concrete here yet. We had a lot of tariffs for, the global, basically every country across the globe. But the real focus has really heavily been on US and China and what kind of impact that can have on things like tech, rare earth metals, and all this other stuff, and retail stocks, all this stuff that can really drive the US economy. So we're very interconnected here. Obviously, we have a lot of global economic concerns, and this, if it goes south, could certainly derail the market. And if it gets cleared out, could certainly set up some further upside in the market. So we'll see how that all plays out. Along with that, we have the FOMC. So tariffs, there's been conversation about how that could impact inflation. Well, that has an impact back on the FOMC. How do they manage their monetary policy given an environment of tariff negotiations where there's not 100% certainty on where these things will be wrapped out in the future, either the near or long term? So making long-term economic growth forecasts that then impact the interest rate decisions is a crucial part of the Fed's job, or maybe the main element of the Fed's job. And so how do they manage this with concerns of what could happen with inflation? How can that pair with interest rates? How can the economy continue to grow at current rates? All of that is definitely in focus. And I think that even with if we get a resolution in the US-China tariff negotiations, the impacts may take a while to be fully visible, and then the Fed's going to have to continue to react. So the Fed is an ongoing concern or ongoing element for this market and how they react to economic inputs. Now, before we get into the stocks and sectors du jour that seem to be coming about, I want to talk about options. So where I started my career was on the option side without the technical and fundamental input. So let's start you guys with the option side of it as well. It is important to understand that options have risks that may be different from the equities market. Transaction costs are often higher in options, higher commissions and fees, because these are a leveraged contract and a bit more complicated than just a simple equity position. There's assignment risk if you have short options positions. What we're talking about today is going to be a long option only strategy. So assignment risk doesn't necessarily apply here, but when you're dealing with spread trades or naked short options, please be aware of the assignment risk, as that is a shift in the capital requirements and risk profile if you do get assigned on a option. But these long options do decay. They decay in value over time because they are in effect insurance contracts. One of the initial purposes of an option was to be able to buy a put option as a way to insure or hedge against a long stock position. Now, these are term insurance. They have an expiration date, which means that every day that passes, they decay in value because there are fewer days for that move to come into play. And then we would have to, in theory, re-up that insurance with a new options contract with a new expiration date. Along with that is volatility. Now, implied volatility is the expected future movement, while realized volatility is the historical movement. Implied volatility is the input to the options model, and it is constantly changing. We'll touch back on volatility as we go through the presentation, so I'm not going to necessarily spend too much time on that part right here. Let's get into some more basics of options first. Why do I use options instead of stock? Well, if I have a $100 stock with a $120 price target in the next month, and my stop loss is a 10% risk down to $90, and I'm willing to lose $1,000 if I'm wrong, I can buy 100 shares of stock paying $10,000. And if it goes down $10 per share, I lose $1,000 and I'm out. And if I think it's going to $120, my reward potential is $2,000. So I have a positive expected return here, where my expectation is a higher move to the upside than my risk to the downside, assuming I can execute my exit at $90 a share. So that's a risk that I think a lot of people sometimes forget. A stock can gap lower below my expected exit. Inputs like earnings or surprise fundamental inputs. Tariff announcements, we had gaps in the market in many different spaces. When DeepSeek AI came out, we saw stocks gapping down magnitudes of what I think people would have ever expected. And that stop actually could not be executed at the previously expected level. So people could have lost more than what they think they have in terms of risk going into it. So the max risk on any stock position is technically the amount of money that I put into the trade. In this case, it would be 100 shares times $100 or $10,000. In the options market, on the other hand, I can now start to create a combination of both leverage and defined risk. So the definition of a call option is a contract that gives me the right but not the obligation to buy a asset, in this case a stock, at a specific price, the strike price, on or before the expiration date. All right, and so if I have a stock option expiring in 1 month, July 10th, that gives me the right but not the obligation to buy this stock for $100 per share, I'm going to pay a premium because now I've got defined risk and leverage, and that premium may be, say, $5 per share. So if I still have that same risk tolerance of $1,000, I can buy 2 contracts representing 200 shares. So each contract represents 100 shares, so 2 contracts would represent 200 shares. That would cost me 200 times $5 per share, so $1,000. Now I control the opportunity to buy up to 200 shares, and thus my upside is larger. If this stock goes to $120, each of those call options is now worth $20 per share, the distance that it is in the money, and thus worth $4,000 total. Minus my initial investment of $1,000, I have that potential for a $3,000 return if I hit my upside target. On the downside, I just don't exercise my call. That's the beauty of long options. If the stock is trading for 90, why would I exercise a call and give myself a locked-in price of $100 a share? I'd be better off going to the open market and paying $90 a share. So given that setup, I no longer have to worry about whether or not I can execute my stop loss. I always have a max loss of a premium paid in order to make sure that I avoid that gap risk to the downside. Now, to put that comparison on a single chart, basically the stock here in purple, 100 shares, versus the option in blue. Now, if I'm buying 2 calls, I need the stock to get above $110 a share to start performing better on the upside. My defined risk kicks in below 90. So if I woke up tomorrow morning and my stock that I thought I was going to get out of for 90 bucks a share is actually trading 80, I'm losing $2,000 in my stock position, but I'm still only losing $1,000 in my options position. And if I wake up tomorrow and this stock gets taken over for 150 bucks a share, I have this massively leveraged return on the upside from being long call options instead of stocks, since I'm controlling 200 shares instead of 100. That's where we're really looking for when we're trading options, is a scenario where I have this high expectation of upside and I want that defined risk to the downside. Now, volatility is a big input because that really helps me fine-tune the price that I have to pay for this defined risk and leverage. So the value of options is partially dictated by implied volatility, as well as a number of other inputs, such as the strike price, which is set, the time to expiration, which is set, but implied volatility is constantly changing. The VIX index that we're going to look at here in a couple of slides tells us what the current market is expecting for future S&P 500 movement. And it's often referred to as the fear index because it goes up when markets are panicking. And you'll see that very clearly when we look at the chart for the VIX. I mentioned before, realized volatility is what we've seen occur recently. Implied volatility is what we expect in the future. Now, you got to keep in mind that realized volatility does not guarantee future volatility, and that's to the up and downside on that. When we've had a very volatile market, we may start to just take a pause, a freeze reaction by the market participants. I don't know whether to buy or to sell, so I'll just do nothing. And when we're going into something like earnings, the stock may freeze ahead of earnings as people say, well, I'm not sure exactly what to do with this stock, if it's overvalued or undervalued, until I have that fundamental input. And then we get a big move, and then the stock might start to move at a different rate going forward. So implied volatility is the big element for options, as it tells us what the market's expecting in the future and dictates the price. Higher implied volatility means more expensive options. Lower implied volatility means cheaper options. Visualization of this. If we have a normal expectation of mean reversion, i.e. implied volatility doesn't tend to trend up or trend down, it has a baseline that tends to kind of snap back over time. So when implied volatility gets too high, market participants may walk away from the market. We tend to then start to see the market stop moving quite so wildly, start to consolidate back into a normal range. Implied volatility comes down with it. When the implied market has been sitting for a long time, it sets up a coil effect where the market may start to explode, and then all of a sudden you've got implied volatility rising. Now, in a comparison, when you've got implied volatility at a low level, let's say 30% relative to what might be expected to be the long-term normal value of 36 or a high value of 42%, you can see the shift in the value on these options. At the money option, the $100 call in my pretend stock here, it can have a shift of as much as 17% on a 6% move in the implied volatility in terms of the value, right? So if the implied volatility is near the lows, I get to pay $840 for 2 call options instead of $1,008 on a fair implied volatility, or close to $1,200 when implied volatility is high. That's a big difference in my potential P&L when I'm paying 20% more for the option because implied volatility is high. Now I need to get that much more movement in order to make that worth my money. The further in the money an option the further in the money an option gets, so like the right to buy the stock for $94 a share, the less the impact on the total value of the option. And the further out of the money, those really leveraged options, those now have a bigger impact on shifts in implied volatility. So the right but not the obligation to buy the stock for $106 a share, that can move in value up or down at like 30%. Just off of shifts in implied volatility without factoring in the price movement of the stock. Let's get a bit of a different visual here for those that like a graphical representation instead of a numerical. When implied volatility is low, as we are in the left-hand chart here, the leverage is much more on out-of-the-money calls. When implied volatility is high, everything kind of shifts towards being stock replacement. So the trade-off for the at-the-money option is this window here where the orange line is below the yellow line. For the out-of-the-money option, it's here where the gray line is below the yellow line. And you can see that blue line, the in-the-money call, it acts a lot like stock with defined risk to the downside. That's for that same $1,000 investment in these options. Now, the key element, of course, is that I have to have this stock rally significantly for the gray line to kick in at all. At $106 a share, I'm still losing money. So 6% return in the stock, I still lose all my money. I got to get up to about 108, 109 before I start making money, and 110 before I start making more money than just buying 100 shares of stock. Further upside, that's where I start to double or triple my potential return relative to stock. When implied volatility is high, it takes even longer, and the leverage really isn't there. So options tend to be much more about just defining the risk when implied volatility is high. And then there's a choice to be made when implied volatility is low, whether I want to define the risk by having stock replacement or leverage with an out-of-the-money option on top of the defined risk. I don't normally like to use out-of-the-money options when implied volatility is high. At-the-money options tend to be a normal behavior for a lot of people because they can work in multiple different volatility environments. Out-of-the-money options only tend to work in very specific environments where we have big movement and we have low implied volatility before the big movement. If we zoom in here, you can see those break-evens for each option position when the implied volatility is low. It's close to $109 a share in the $106 calls. It's about 105 in the, or 104 to 105 in the $100 calls. It's around 101, 102 in the $94 calls. And of course, it's right at $100 for stock. And then the leverage above is where we really are trying to focus. And again, with that implied volatility high, I need a much bigger move just to break even and an even more significant move to start creating leverage off of that trade. So if I don't see an opportunity here in this stock to make a 30, 40% move when implied volatility is high, I don't really want to buy out of the money options. If I'm only looking at 20%, I actually don't make that much by buying out of the money options expiring in a month in this scenario. I make my money in this scenario on that 20% move. That's why, people complain oftentimes that with a stock going into earnings, it moved 20%. Why didn't I make much money on my options position? It's because it was priced in. Implied volatility was high. All right. So where are we right now with that implied volatility? Well, the VIX is actually near the 6-month lows. Prior to what we saw in April, implied volatility was, 14%. We rose up to about 30% when we started to break in March, and then it started coming back off to 17, and then it spiked. April 7th was a wild day. April 8th was a wild day. April 9th were wild days. We had the VIX up at 60. The VIX, the fear was there in the market, and then it went away because things started to get resolved in terms of tariffs. And since then, it's been drifting lower. We've had little spikes here and there, but the VIX is now at a low point. Now, it could go lower. We could see a return to 13, 14% with more than likely needing some fundamental input, some resolution to the tariff situation, just some concrete knowledge of what it is. It's not necessarily that it has to go away. We just have to know what it is, because then we can expect what happens to future growth. What is the input? Just knowing it means lower volatility. Not knowing means we start to speculate. How high will the tariffs settle in? How low will the tariffs settle in? And we get chop in the market as a result of it. And that volatility is, naturally feeding a higher VIX. But thanks again to the low realized move that we've had over the past few weeks in the market, that's also allowed the VIX to drop. We haven't gone anywhere. So people got frustrated with buying those out of the money options. They're just not paying off. So when they're not paying off and we're staying in this range bounded situation, all these options are losing money, and maybe people are making some money a little bit here and there, trading back and forth on the range, but the options guys, they're just decaying to zero. So they don't make any money, so they get frustrated, so they stop buying options, so there's less demand for options, less fear and less greed, and that allows for the VIX to fall. And then we start to come out of that with an explosive setup at the start of a new trade that may allow for these options to really work. So I want to find a technical setup that can illustrate the potential for a breakout from consolidation, or let me get into that trade at the early part of the move. When we're either starting a new trend or continuing a trend, the biggest thing is we got to get out of that consolidation and start moving. And again, that market consolidation often leads to a lower VIX and thus cheaper options, which means I can get that leverage cheaper, this look, and potentially get a really nice leveraged return with my options, whether I'm in at the money calls, in the money calls, or out of the money calls. I can get a bit more dynamic with it without the money calls to play it safe. At the money or slightly in the money calls, those are going to still work very well and still provide a leveraged return relative to stock. So this is the setup. The main setup that we've been looking at right now recently is a rectangle. This illustrates a stock chart that has been stopping at a certain price point, can't seem to go above it, and stopping at a certain price point on the downside, can't seem to go below it. So if you look at a chart of the S&P 500, you may note that we've been pushing against a price point, but not going through that price point for the last 3 weeks. And we've tested down really against the highs of March 25th without breaching them and found buyers there. There is demand for stocks at the lows. There is supply of stock at the highs. And at some point, demand takes out supply, either to the upside or the downside. If demand is there to buy stocks and there's no more seller, then we have to go to a higher price to find the next supply. If supply or if demand for stocks is falling away and there's still people to sell, then we have to go lower to find the next buyer. And this is the setup that we're looking for right now, where we're looking for the next big seller of stocks, the next person willing to reduce positions. A similar setup that we have seen somewhat here in a few sectors is the triangle. And the reason I like the ascending triangle in that bull setup is because we've had a continually increasing demand for stock throughout that time frame. So rather than having a set in stone price, let's say it's around $100 stock. Somebody's willing to pay 98 to buy the stock. Somebody's been willing to sell it at 100. We're just chopping in between that range. My $98 buyer goes up to 98 and a half, then 99, then 99 and a half. He's just more aggressively buying, and that seller is just standing pat at $100 a share. And finally, when that seller at $100 a share is taken out of their full offering, we go higher. The buyer is still there. The seller is gone. Now he has to decide how high will he pay to buy. And we do have a nice element here where all these algorithmic trades and artificial intelligence and technical trades, the computers, this is what they're trained to basically find. They're looking for patterns. They're looking for supply and demand and saying when there's a lack of supply, they buy. They create more demand. And that creates this potential for going higher because they just want to try to move the stock and see if they can generate a profit. When there are no sellers, they want to be buyers. When there are no buyers, they want to be sellers. That creates that opportunity for everybody else too. And so what we often see in this scenario, is a statistical distribution as follows. When the market gets to that inflection point, we either spike to a new high and then find that new supply, or a seller immediately returns and then we just go back into the range. So we're either going up a lot or down a little. That sets up a great return for those options. If I'm expecting either up a lot or down a little, I'm now helping myself eliminate some of this trade-off zone. Down a little, I'm just in my defined risk zone. Up a lot, I'm shooting through all of these spots where stock would have performed better on the upside, the 1, 2, 3% returns in my theoretical stock here. I start looking at those 10, 12, 15% returns because we're looking for that next seller and it may be way up here. So if I can find a stock that has the setup where I expect the move to the upside to land somewhere in this range, that means that the options are priced for potential success for me, high expected value trades. So where do we find that setup right now in this market? Well, first off, the S&P 500. We've had a shifting setup here. Let me get a pencil here to draw in here. Drawing with a line here. There we go. So you can see we've had supply right here. And we've had demand, and it's been going up. That's my ascending triangle. And on Friday, we broke out, and Monday and Tuesday, we continued higher. The next main supply that people would be looking at here for the S&P 500 is the previous high. It's around 613. Yeah. That's a little bit too low on the drawing here, but you can generally get the feel for it. Around 613 is the next expected landing point. And if we get above that, now new all-time highs, now who knows what the upside is. But this is just getting started. We do have a little bit of resistance above, and this is happening now. That ascending triangle has shown increasing demand, people willing to pay more, and now finally the seller here at around $595 a share is gone. So we got to go higher to find the next seller. All right. Let's switch over to the Russell 2000. Similar setup, same ascending triangle. You can see here we've got about 205 on the high point and that increased demand over recent history. And then the next supply looks like it lands somewhere around here, around 220, maybe a little bit above. So we're trading around 211 on Friday. There's some potential here for about a 5% upside in small caps before we find that next seller. This is good for a technical setup overall, and the market is rewarding those buyers on Friday because we cleared out resistance on Friday afternoon. Or Friday, I guess, during the day. We cleared out that resistance. We're looking for the next seller. We haven't had a fundamental input to push us back lower. And then tech leading the charge here right now, getting very close to the all-time highs. I won't bother to draw on the same ascending triangle here. I hope you can see it. We were up, pressing against resistance. We pushed through it. We had the higher demand. And now the all-time highs in tech are a matter of about 1% away. Now, above that, again, for the long haul, people start to get very excited. So broadly, the whole market, everything looks bullish. Maybe there's some resistance just above market in tech or S&P 500 or small caps. But if we get through that, then what's the next leg higher? And unfortunately, these are big indices that are showing bullishness, but it doesn't mean every stock is bullish or every sector is bullish. There are certain sectors that are leading that charge and others that aren't. I mean, utilities don't look that great right now to me. They don't have that same kind of technical setup. So I can, instead of just buying into the S&P 500, I can go down a little more fine-tuned and find something that's got more leverage to the upside. One sector that I'm going to go through first is actually going back to the counter to our China trade tariff negotiations. The Chinese stock market, FXI, large cap Chinese stocks, is pressing against highs and hasn't quite pushed through yet, although now it has. So on Friday it hadn't, but now it has. Similar setup to the broad market, it actually is trading near highs. Doesn't look like these tariff negotiations are drastically hurting either stock market in China or the United States right now, frankly. But this is starting to break out now. Sets up for those at the money or in the money call options for a leveraged return. Even if it's capped at $39 a share in FXI, I could get some leverage on the way there. And I don't need to see a price move to 42 to make money. Ultimately, if we break out to the all-time highs, maybe that out of the money call option would have played off better. But using something closer to at the money or slightly in the money, I can still generate some nice returns. Similarly, the Magnificent Seven has actually been stalling a bit here. So the Magnificent Seven, the 7 biggest tech stocks, that's not leading that tech charge forward. These are the Apples, the Amazons, Microsoft, Broadcom, Alphabet. I'm missing a couple in there, but you get the idea. These have not yet broken out. People have actually moved away from the big tech names, the biggest components of the NASDAQ, and been more aggressive with other names like Palantir, cryptocurrencies, artificial intelligence, semiconductors, which I'll actually bring up next. And you can see the demand here has actually been a little bit more stable. We haven't had increased price buyers in the Magnificent Seven. They've been pretty stable here near the lows, pretty stable on the sellers near the highs. This may be breaking out now, but as of Friday, we weren't quite there. And we tried last week, by the way, or a week and a half ago, when people first said that, when it was first announced that tariffs could no longer be put in place because of the way that they were implemented. And then 24 hours later, or less than 24 hours later, they were put right back in place. We had that false breakout. That's that risk that we have with the breakout trade. News came in, false breakout, back to the middle of the range. Maybe this time we'll clear out. Semiconductors have been doing very well. Semiconductors had more of a rectangle setup, as you can see here, than a ascending triangle. But those did finally break out, and they are leading tech higher. So it's more semiconductors than it is Magnificent Seven. It's more AI than it is Magnificent Seven. These are some of those potential sectors to find some serious momentum, some serious investment flow. And investment flow is really the name of the game. Where's the money going, and who's the next seller? And then my last sector that I think was surprising to me, and it may surprise you, retail stocks. You're like Target, Macy's, Nordstrom, whatever, just brick and mortar retailers and a number of other retailers out there. I think Amazon is part of this. XRT incorporates a lot of retail stocks, and retail stocks are supposed to be really badly impacted by tariffs. Inventory costs go up higher. They're passing along those costs to consumers. And yet retailers have had an ascending triangle here. As you can see, we've been going up against this resistance with more aggressive buyers over the last few weeks. So why is retail Why are retailers going up? Maybe it's because the market realizes that it can't get any worse for them, and they're still doing okay based upon their earnings. I'm not quite sure, but at the end of the day, retail stocks look awfully bullish, and this is why I go through this analysis on a lot of these different sectors, is because I'm no fundamental analyst other than in terms of, like a big bank fundamental analyst. I'm not going to compete with them, but what I can do is I can look at the charts and see where they're putting their money. And when they're putting their money in retail, it means that they know something about the retail environment, the retail stock environment, that tells them these prices are too low. And so I can say, well, the people that are doing the research believe in retail companies. And so I am justified in believing in them as well. And I can break it down into individual stocks. Maybe it's Walmart, maybe it's Target, maybe it's something else that looks particularly bullish within the sector, without having to have that exposure of doing all of the, K1 research or the 10 Qs and all the, reevaluating all of their earnings announcements. I can just follow the flow and look for that leveraged options return that gets me a move to maybe $80, $85 a share by buying, an at the money call expiring in 3 months, and just go with the flow. And that's what we're looking for right now. And that's what I'm looking for right now, is a move out of this recent range and into new bullish trends. And for whatever reason, retail companies looks like one of the best. So, a few surprises in there, maybe a few that looked maybe no surprise, like semiconductors. But hopefully this helps you all identify how you can look for some opportunities that are similar in other sectors and other stocks. If there are any other questions, you can always contact me, Keith@optionhotline.com. Again, my phone number 312-620-8004. And keep an eye out for support@optionhotline.com for those free giveaways. And with that, we'll take any questions if there are any at this point.
Thank you so much, Keith. That was a ton of great information. I'm going to ask you to leave the screen up just for a moment so everyone has enough time to write down your contact information. As Keith noted, if any of you have follow-up questions for him specifically about his presentation or anything else, please feel free to reach out to him directly. He's got his phone number and his email here, so that's great information to have. Thank you for doing that, Keith. We have a minute or so if anyone wants to ask any questions live. Now is your chance. Otherwise, as noted, you can reach out to Keith after the fact. Additionally, if you have questions or thumbs up, shoot us an email at info@avant.com, and we can answer those questions for you if they're in regard to Avant-Garde, or if it pertains specifically to Keith's presentation, we can get those over to him. So I'm going to take the screen back just for a moment here, wrap everything up. Thank you again, Keith, for taking the time to put that presentation together and go through it so thoroughly. I do appreciate it. I know our participants appreciate it as well. Just one other reminder for everyone here and those of you watching the replay, don't forget to visit avantgardetrading.com, check out our education page so that you don't miss out on our upcoming educational webinars. Make sure you subscribe to our mailing list, click the big blue register for webinar buttons. We have another one coming up in August with the Options Industry Council, and we'll be sure to have Keith back as well for another educational webinar in the coming months. So please keep your eyes peeled and be sure to join us. Thank you again, Keith. I hope you have a good rest of your week. And we will
Thanks again, everybody.
soon. Yeah, thanks a lot. Have a good one and good trading to all.